Okay, so we'll do an exam question showing how we can work out the adjusted profit for the year. So just a quick reminder, this thing here is the layout of the income statement. And I've tried to use two different colors and I'm going to try and explain what they are. So revenue, so that's your sales, so that's an income, and sales return, that's an expense, so it gets deducted. So, cost of sales, so remember the formula, open inventory plus purchases, minus purchase returns, minus goods for use, plus carriage inwards, and then minus closing inventory. These are all different incomes, and there's lots more we could have. And here are expenses, and again, there's lots more we could have. Now, I've tried to do it so that the red is different forms of income, and blue is different expenses. Now, the only thing I need to try and convince you about is this inventory. Now, we know that inventory is not an expense or an income. Inventory is an asset. However, for the sake of an income statement, if we just think of the open inventory as an expense, because it's something that's had to be paid for this year, whereas closed inventory hasn't been sold this year, so therefore it's kind of like a prepayment. So I don't pay for it this year. So we think of kind of getting the money back for the closed inventory. So it's kind of like an income. And if you can think of it that way, it makes sense why that one's blue and this one's red. So all the reds are forms of income, all the blues are forms of expense. And if you can remember that, you just have to remember then that if an income increases, profit increases. If an income decreases, profit decreases. So if the reds go up, profit goes up. If the reds go down, profit goes down. Now, if an expense increases though, profit will go down. But if an expense decreases, profit will go up. So it's kind of the opposite for an expense. Okay, so I'm going to keep referring back to this. So here's an exam question. This is from June 2012, question 3, unit 2. So just have a read of the exam question if you haven't already. It's about Laura ordered a number of shoe shops. She's done an income statement and a balance sheet, which remember just means statement of financial position. She's given us the profit for the year and net current assets. Now, net current assets just means current assets take away current liabilities. Yeah, that's all net means, just means the total when we take away the bad stuff. Okay, so there's going to be 6 adjustments, and we're going to have to identify how it will affect the net profit and the net current assets and work out what the accounting concept would be. So, first one, Laura receives some shoes costing £250 from a new supplier on a sale or return basis. So that's key there. So I'm just going to highlight that. And the shoes have not yet been sold and were included in the closing inventory. So as it's sale or return, technically that stock isn't hers because it's still the supplier's. She's just the middleman, so she shouldn't have included in her closed inventory. So she needs to take it away from the closed inventory. Now, the closed inventory was a form of income, remember we said. So if that goes down, profit goes down. So that's why it's in brackets there. And it's also a current asset. So if that goes down, the net current assets will go down. And the accounting concept is realization because the thing hasn't been sold yet because it's on sale or return. So therefore, we can't change ownership yet. Okay, the second one, let me just unhide it. So Laura paid for her own health club membership amounting to £375 business check. This has been charged to sundry expenses. Now, we know that the accounting concept is business entity because she should have kept her personal gym membership separate. So that means we need to take away that from the sundry expense. So the expense is going to go down, which means the profit's going to go up by 375. And that's not going to have any effect at all on the net current assets because the other side will affect the drawings account, and the drawings account doesn't affect current assets or current liabilities. So nothing changes for the net current assets for that one. Number 3. So shoes costing £4,000 had been included in the closing inventory stock valuation. The shoes would normally sell for £6,000. So remember, we ignore that number. I don't care about selling prices. However, they are shop soiled and damaged and will need to be repaired before they can be sold. It is expected that the repair cost will be £825 and that they can then be sold for £4,500. So for this one, we need to work out the net realizable value. So to do that, we do the 4,500, take away the repair costs of 825, and we get 3,675. So what we call this is prudence, and prudence says we have to take the lower value. So we have to take the 3,675. So it's not going to be 4,000 anymore. It's going to be reduced by, well, the difference is £325. So my closing inventory is going to go down by £325. So that means my income is going to go down. So that means it's going to make my profit go down. And again, if my closing inventory goes down, my asset goes down by £325. Okay, fourth one. Laura rents out a shop. Rent receivable of 14,000 had been included in a draft income statement. This included £2,000, which was for the year ending 30 April 2013. So we double check this year was the year ending 2012, and that's 2013. So we have 2 different years. So that means she's received £2,000 prepayment of income. So that £2,000, this £2,000 here, shouldn't be included on the income statement. So I'm going to take that away from the income. So that means profit's going to go down by £2,000. Now, if I've got a prepayment of income, remember that means that it's a liability because we owe that money back to whoever rents the shop if they ask for it at the end of the year. So that £2,000 is going to be another payable. We know that's a liability, so the liability is going to increase. Current liabilities will increase, which means my net current assets will decrease. And the accounting concept for this one is accruals, because everything should be matched to the year it should be due in. Number 5. So on the 4th of April 2012, new fixtures and fittings were purchased at a cost of £3,000. The fixtures and fittings were bought on a 12 months interest-free credit. It is Laura's policy to charge a full year's depreciation in the year of acquisition. So that just means the year it's purchased. Depreciation is provided at 33 1/3% using the reducing balance method. No entries has been made to record this transaction. Well, we need to work out depreciation. So depreciation, we would do £3,000 times that percent, which just means divided by 3. Depreciation for the year will be £1,000. So that's going to increase in expense. So that's going to decrease my profit by £1,000. Now that £1,000 will also decrease my non-current assets, but that'll have no effect on my current assets. And again, the reason for this is accruals, because the depreciation needs to be matched to the year, or we could also have prudence, because we can't overstate the value of our non-current assets. We could also mention consistency, because depreciation needs to be consistent. However, since it's the first year, I wouldn't really mention that one. And finally, number 6. So Laura has not included any entries for provision for doubtful debts in the draft final financial statements. The provision for doubtful debts at the 1st of May was 1,250, and at the end of the year it was 1,050. So it's a decrease, and it's decreased by £200 for doubtful debts. Now we know that if a provision for doubtful debts decreases, that's an income. So if my income goes up by £200, my profit's going to go up by £200. And it says that she's not included any entries for provision for doubtful debts in the financial statements. So that also means that my current assets are going to change as well. So the other side would be the trade receivables that would be affected. So the trade receivables would decrease by £1,050. So that means that the current asset would decrease. So my net current assets would decrease by £1,050. And again, the reason for that would be accruals, because we need to make sure that trade receivables are in the right year and any reductions are in the right year. Prudence, so that we don't overstate our trade receivables, and also we can have consistency. It needs to be the same each year. Now, I've also just spotted in question 5 if she's bought it on credit. I didn't spot that there. So it says here, bought on credit. So that means she's got a trade payable now. She's got £3,000 trade payable. So that means that the current liabilities will increase by 3,000, which means the net current assets will decrease by £3,000. So I missed it out there. Okay, then all we need to do is just total them up. So type them in your calculator, and you should get, for the first one, £65,745, and for the second one, it should now be a negative 1,136. So that just means that the current liabilities are bigger than the current assets by £1,136.